Alphabet just reported its second quarter earnings, and once again, the company delivered some impressive numbers. But with billions being invested into AI, growing competition in search, and the stock taking a hit from record highs, the big question for investors is Alphabet stock still a buy? In this video, I'm breaking down Alphabet's second quarter results. Take a look at the charts, discuss the three biggest risks to the business, and I'll give a one-year price target for the stock. As always, everything on this channel is free. I'll never try to sell you a course or a membership. I'm just a normal guy who enjoys investing and sharing my research. Let's generate alpha. Let's start by looking at Alphabet's most recent quarterly results. And overall, I thought this was another very impressive quarter for the company. Alphabet generated $119.8 billion in revenue, representing 24% year-over-year growth, which was well ahead of Wall Street's expectations of around $117 billion. Looking at the different business segments, Google Services, which includes Search, YouTube, Android, Gmail, and Google Play, generated $94.5 billion in revenue, up 15% from the same quarter last year. The biggest contributor remains Google Search, which brought in $63.3 billion, growing 17% year over year. That's particularly impressive, given all the concerns over the past year that AI chatbots could reduce Google's search business. Instead, management said AI features such as AI overviews and AI mode are actually increasing engagement and helping drive more search activity. YouTube also delivered another strong quarter, with advertising revenue increasing 13% to $11.1 billion. The company benefited from strong user engagement, including massive global interest around the FIFA World Cup, while continuing to improve recommendations and introduce new AI-powered features across the platform. But once again, the real standout performer was Google Cloud. Cloud revenue surged an incredible 82% year over year to $24.8 billion, making it one of the fastest-growing cloud businesses anywhere in the world. Demand for AI infrastructure, Gemini models, and enterprise AI solutions continues to accelerate, with the company's cloud backlog growing to an enormous $514 billion. This tells investors that customers are committing to Google's AI platform for years to come. Profitability also remained very strong. Alphabet reported operating income of $40.8 billion, up 30%, while operating margin expanded to 34%, showing the company continues to grow earnings even while investing heavily in artificial intelligence. Now, one number that immediately jumps out is net income of $112.1 billion, or $9.11 per share. At first glance, those figures look extraordinary, but there's an important detail investors need to understand. A large portion of those earnings came from unrealized gains on Alphabet's equity investments, including its stake in SpaceX, rather than from normal business operations. So while the headline earnings per share look spectacular, it's more important to focus on the strength of the underlying business rather than that one-off accounting gain. Alphabet did not officially report an adjusted EPS in its earnings release. Many analysts estimate that Alphabet's adjusted EPS was approximately $2.85 per share after excluding that one-time investment gain. This represents growth of about 23% year over year. So what caused the stock to drop after the earnings release? The biggest area that concerned investors was capital spending. Alphabet spent $44.9 billion in capital expenditures during the quarter, more than double what it spent a year ago, as it continues building AI data centers and expanding computing infrastructure. Management also raised its expected 2026 capital expenditure guidance to between $195 billion and $205 billion. That heavy investment caused free cash flow to turn negative for the quarter, which is one of the main reasons the stock sold off after earnings, despite reporting excellent operating results. Overall, though, I think this was another outstanding quarter for Alphabet. Revenue growth remains exceptionally strong, search continues to dominate, YouTube keeps expanding, Google Cloud is growing at an incredible pace, and AI is now driving growth across virtually every part of the business. The market may be worried about the enormous AI investment today, but if those investments continue producing the kind of growth we're seeing now, they could position Alphabet for many years of future success. Let's take a look at the charts. At the moment, Alphabet is trading below both its 50-day moving average and its 200-day moving average. This is generally considered a bearish technical signal. The 50-day moving average represents the stock's shorter-term trend. Since Alphabet is trading below this level, it suggests that short-term momentum has weakened and that sellers have recently been in control. The 200-day moving average is even more important because it helps measure the longer-term trend. Alphabet trading below this level suggests that the stock's long-term technical momentum has also weakened. The 200-day moving average may now represent another major resistance level. A sustained move back above it would be a much more encouraging sign and could indicate that buyers are beginning to regain control. The Relative Strength Index measures momentum on a scale from 0 to 100. An RSI above 70 can indicate that a stock is overbought, while an RSI below 30 can suggest that it is oversold. The RSI is around 30. It suggests that the recent selling may have become excessive and that the stock could be due for a short-term rebound. Overall, Alphabet's technical chart currently looks weak. The stock is below both major moving averages, and buyers have not yet regained control. However, this may also create an interesting situation for long-term investors. A weak chart does not necessarily mean the underlying business is weak. It may simply mean the market is concerned about valuation, AI spending, competition, or future growth. Here are 3 of the biggest risks that could meaningfully impact Google shares going forward. The biggest risk to Alphabet is also its biggest opportunity: artificial intelligence. For over 2 decades, Google Search has been the company's cash cow, generating tens of billions of dollars in advertising revenue every quarter. But the way people search for information is changing. Instead of typing questions into Google, more people are turning to AI tools like ChatGPT and other conversational assistants to get instant answers. If this trend accelerates, Google could see fewer traditional searches, which may reduce the number of ads users see and ultimately impact advertising revenue. Now, Alphabet isn't standing still. They've rolled out AI overviews, AI mode, and continue investing heavily in Gemini. So far, management says these AI features are actually increasing engagement rather than reducing it. The second major risk is regulation. Alphabet has become so large and dominant that regulators around the world are paying close attention. The company continues to face antitrust lawsuits in the United States and Europe involving Google Search, Android, Chrome, and its digital advertising business. If regulators force Alphabet to change how it operates, it could impact future growth and profitability. The third risk is the enormous amount of money Alphabet is investing in AI. The company is spending hundreds of billions of dollars building data centers, purchasing AI chips, and expanding cloud infrastructure. These investments are necessary because AI is becoming one of the most important technologies of the next decade. However, there's always execution risk. If Alphabet spends all of this money but demand slows, competition increases, or customers don't generate the expected returns, these investments could take much longer to pay off. In the short term, these huge capital expenditures are also putting pressure on free cash flow, something investors have already noticed after recent earnings. Now, the big question: where could the stock go from here? Most analysts maintain a buy rating with an average price target of about $428. Looking at the discounted cash flow model, the base case estimated value for the stock is about $319, and the best case is $676. Please keep in mind that DCF is highly sensitive to assumptions. Even small changes to growth or discount rates can swing the fair value dramatically. As for my opinion, in February I gave Alphabet a buy rating and price target of $375. It flew past that and went up to $400. Today I am also giving Alphabet a buy rating with a one-year price target of $425. Here are 3 reasons why I believe it's a buy. The first reason is simply the quality of the business. When most people think of Google, they think of search. But Alphabet is so much more than that. The company owns YouTube, Android, Gmail, Google Maps, Chrome, Google Play, Google Cloud, Waymo, and Gemini AI. Billions of people use at least one Alphabet product every single day. This creates an ecosystem that's incredibly difficult for competitors to replicate. Even better, Alphabet isn't dependent on one single source of income. Search advertising generates enormous cash flow. YouTube continues to grow. Google Cloud is becoming a major profit engine, and newer businesses like Waymo and AI could become significant contributors over the next decade. The second reason is artificial intelligence. Many investors see AI as a threat to Google. I actually see it as one of Alphabet's biggest opportunities. Alphabet has spent years developing AI technologies and has some of the world's leading AI researchers. Gemini is improving rapidly, AI overviews are now reaching billions of users, and businesses are increasingly adopting Google's AI tools through Google Cloud. The company is also integrating AI across Search, Gmail Workspace, Android, YouTube, and virtually every major product it owns. Because Alphabet already has billions of users, it has a massive advantage when rolling out new AI features. If management executes well, AI could become one of the biggest growth drivers in the company's history. The third reason is Alphabet's financial position. Very few companies generate the amount of cash that Alphabet does. The company has one of the strongest balance sheets in the world, with a huge cash position and very manageable debt levels. That financial strength gives management tremendous flexibility. They can continue investing heavily in AI, acquire promising companies, repurchase billions of dollars worth of shares, and even increase dividends. When we put everything together, I see a company with world-class businesses, enormous competitive advantages, exciting AI growth opportunities, and one of the strongest financial positions in the market. Will the stock experience volatility? Absolutely. There will be concerns about AI, regulation, and short-term market sentiment. But if you're investing with a 5 or 10-year time horizon, I believe Alphabet remains one of the highest quality companies you can own. It's exactly the kind of business I like to buy, hold, and allow compound growth to do the heavy lifting over time. Let me know in the comments, is Alphabet a buy here? Thanks for watching. If you enjoyed this video and want more earnings recaps with one-year price targets, please like and subscribe. Until next time, keep earning, keep saving, and keep investing. I own Alphabet shares through an S&P 500 index fund. This is not financial advice, just my personal opinions. Make sure you consider your own risk tolerance, time horizon, and financial situation before making any investment decisions.